Hello friends, welcome to the Market Message. I'm Bill Valentine, doing my part to make you a better investor. Before we get into the topic this month, let's take a look back at the performance for the month of October and on a year-to-date basis. As you can see, all asset classes were slightly down last month, with REITs notably off 5%. That's due to the expectation of higher interest rates. On a year-to-date basis, we're still in positive territory for the five big groups, with a notable spike from commodities in the back of recovering oil with a 12.3% year-to-date number. The topic this month is the question of whether or not the election is a black swan. And so, to paraphrase Inigo Montoya, if you're using the term black swan, I don't think you know what it means. The concept of a black swan is an event that is highly significant, creates a magnitude of change, but was unanticipated. And so you can't use the term black swan to describe something that we're all watching relative to the election, day to day, minute to minute. So the bigger question really is there something going on with the election, or will something result out of the election that will hurt investors in the long term? And that's what we're going to delve into for the next couple of minutes and look at some things that I think will give you some clarity on this. Here's what I can say about the election. I've got bad news and good news. The bad news is that in about a week's time, we will know that the next president will be either Hillary Clinton or Donald Trump. The good news is it doesn't really matter, and it matters certainly a lot less than people are expecting, as judged by the behavior in the investment markets over the last week and a half. We're in this really strange environment now where the price of insuring against a downfall has exploded, and we've now had 8 days in a row of the S&P 500 being down. The last time that happened was in 2008. In the middle of the financial crisis. So it begs the question, is there something going on right now in the world that equates to the magnitude of significance of the financial crisis? And of course the answer is, heck no, there isn't. Undoubtedly the outcome of the election will create volatility, but as an investor, who really cares? And the only people that seem to care right now are the people that are bidding up the price of insurance to extraordinary levels. And I think in hindsight they will regard this decision to pay for insurance, whether it's in put options or in whatever measures they're taking, as having been overwrought and unnecessary. And that's because there's two kinds of meaningful events. There's short-term meaningful and long-term meaningful. And as an investor in the long term, the only things that really matter are long-term meaningful events, significant drawdown periods of bear markets. And the most important thing to understand about the difference between short-term volatility and long-term damage is that you don't get significant long-term damage to the prices of stocks and other related growth assets unless there is a material economic contraction. In fact, go back over the last 35 years, we've had two periods of really bad returns for stocks, 2000 to 2002, 2007 to 2009. Both of those coincided with massive economic contractions. And so the question is there something about the election that could create a massive economic contraction? The answer is no. There is a recession in the offing. There's always going to be a recession coming up at some point. The election in and of itself does not have, in this election of the president, does not have the impact on the economy that people seem to be bidding up in the prices of insurance. I'll remind you that I did a video a couple of months ago that I would refer you back to here at valentineventures.com called "The President Doesn't Matter." You should go back and take a look at that if you're not sure why the political party or the candidate themselves has any impact in the long term on markets or the economy. For certain, the market doesn't like risk, and what we've seen over the last couple of days is a narrowing in the race for president between Trump and Clinton. In fact, there's a great website, 538.com, that's keeping odds on who might be president. It's going tick by tick, and it's seen, or it's showing us that Donald Trump has gone from basically an 11% chance of winning the election just a few weeks ago to now, let's take a look. Here you can see that according to this 34% chance now, with still several days to go. So it's a really interesting website if you want to kind of handicap this thing going forward. But I was referring to the fact that there's been an extremely high increase in the price of insurance, and you can see that in the volatility index that we're looking at here, the VIX index. And without getting into too much definition of how the VIX works and what it measures, you can think of it as the cost of insurance. And what you're seeing here is a spike in the cost of insurance. We're at a level now that we haven't seen since the post-Brexit crisis. And I'll talk about Brexit in just a second. But also, as I mentioned, stocks have gone down now 8 days in a row, indicative of some kind of economic catastrophe that simply is not in the offing. There are two kinds of events that I'm referring to here. The short-term, highly volatile, non-meaningful event, and the long-term, detrimental, stock price hurting events. The difference being the presence or the absence of an economic contraction. We've had many of these short-term, highly volatile, very panicky environments over the last several years. And let me just sort of whip through the litany from memory here. Most recently, Brexit. You remember in June when Brexit happened, I came out right after that and I told my clients this is not going to be a meaningful event, and it was not. Prior to that, we've had, let's see, the U.S. debt downgrade. We had the Greek riots. We had a flash crash. We've had an oil-driven stock market crash. We've had a China-driven stock market pressure. We've had volatility related to Ebola. I mean, it just goes on. And every single one of these events was not a meaningful event over time. So as a long-term investor, you didn't need to hedge yourself against the short-term volatility. You've got to be able to, as I've said in this video from time to time, take a punch. That punch is short-term worry that's being manifested in volatile prices for assets. And you need to make the distinguishment, as I said, between that and a meaningful collapse in the price of securities over time, driven by the drawdowns that come on the back of an economic contraction. So very simply, folks, as I said in the last video about the presidential election, if you're giving this a lot of time and thought and concern, you need to find something else to focus on. If you're an investor, there's nothing to be done. There are people that are going to try to play this thing over the course of the next couple of weeks, betting on recovery, betting on the market falling, betting on the market being volatile, non-volatile. That's just a fool's errand. You don't need to trade against that kind of thing. It's almost impossible to get right consistently over time. So, in the meantime, hang in there. Let's watch this election together. It should be quite a show, but it won't have a meaningful impact on your investments over time. I'm Bill Valentine, signing off until we find out the new president. Wishing you all the best, and we'll see you back here next month.